All right, thank you guys for coming to the financial component of our wellness program. Kaylee asked me to give a presentation on taxes, so hopefully you guys are prepared for that and ready to learn some information on taxes. Just a quick background on myself. I went to school in Des Moines at a business school called AIB College of Business. After I graduated from there, I went to Drake University and completed my master's in accounting program. I became a licensed CPA in 2013 and worked for a CPA firm both while I was in school and then after I graduated, and then started here at the hospital in 2016. So originally grew up in Red Oak and the ability to move back close to family. And at that time, we found out we were expecting our first, so being back close to grandma's and free daycare was something I couldn't pass up. So been at the hospital since 2016. And then just like any accounting or legal disclaimer at the beginning of a presentation, this is not legal advice. So just give you guys some information, but if you have any specific tax questions, you obviously have to work with your tax professional. So real quick, just to get a gauge on the room, I have a couple questions. Has anyone in here actually filed their taxes for 2023 yet?
Will be short.
Starting on it soon. Yep, perfect. So the timing of this is perfect. Who has kids, grandkids, nieces, nephews? Quite a few people, most in the room. I have a couple slides later about some deductions and some tax credits are available with kids, nieces, nephews, grandkids, things, all those family relations. So I'll talk about that. I hope everyone's hand goes up on this. Who wishes they could pay less in taxes? 100%. Yep. When I worked at the CPA firm, it was always interesting. People didn't mind paying taxes, but they always felt like what they paid it to was maybe not spent the best, and that's why everyone wants to pay less taxes. So I'm in the same boat as everyone in the room. A couple important dates to remember. Like I said at the beginning here, this is really good timing because most of your tax forms have to come out by the end of January. So we're just a couple days into February. Everyone in here should have gotten their W-2s from the hospital by now. If you haven't, you can get a copy on your UKG Kronos login. If you have any investments, savings, things like that, all of those statements are due out by the middle of February. So just a couple weeks away. Couple deadlines to keep in mind on when you have to file your taxes. So filing for the federal income tax return is due April 15th. And filing for Iowa is at the end of April. So make sure you don't miss those deadlines. Life-changing events. Some of the tax changes or the implications to your tax return usually surround a life-changing event. So if you don't have any big life-changing events, your tax situation is probably going to be comparable from one year to the next. But if you were to get married, it's going to change your filing status from single to married filing jointly. If you were to get divorced, obviously the opposite of that. If you have had a kid in the last year, that's something you want to make sure you include on your taxes with some of the child tax credits, daycare credits, things of that sort. If you bought a house, there's some credits that are available, some deductions that are available for like your mortgage interest, property taxes you pay related to your house. If you attended college, there are some college education credits, continuing education credits that are available. And then if you started in a new job, you want to keep in mind the amount that you have taken out of your paycheck. So your withholdings and what's coming out of your paycheck. So anytime you have those life-changing events, keep those kind of things in mind because they can have a big impact on what your tax situation looks like. Real quick, I'll cover the different statuses that you can file your taxes as, and then a couple of brackets on where taxes are calculated. So there's really three main statuses that you can file on your taxes. You can file as single or married filing separately. A lot of times we'll get questions on, should I file as single or married filing separately? The vast majority of the time, if you are married, you want to file married filing jointly. There's very few situations where being married and filing separately would actually be advantageous. So single or married filing separately, married filing jointly. And the married filing jointly is depending your status of being married or not at the end of the calendar year. So when I worked at the CPA firm, we would get a lot of questions of, I got married in June, do I file as single this year? Since I was single part of the year, married part of the year, it's whatever your status is at the end of the year. So if you're married in June, you would file married filing jointly for that whole year, even though you were married midway through the year. And then the last one is head of household. So with this one, it's if you're a single parent, you have a kid at home, you can file as head of household. The tax brackets are a little bit more favorable than if you were just filing as single. Another situation that many people don't think of for head of household is if you're an adult and you have maybe an elderly parent living with you that is dependent on you for both their care and their financial resources. So it doesn't have to be a single parent with kids in the house. It can be anyone that's a dependent that lives in your house. So those elderly parents do qualify for that, or elderly relatives. Everybody is allowed a standard deduction. So what this is if you take your annual income for the year, the IRS gives everyone a standard deduction that you can reduce that income amount. So how much is tax will be reduced by this standard deduction. So with the different filing statuses that we just talked about, here's the dollar amounts that are available for those standard deductions. So if you are single and you make $50,000 a year, you're only going to be taxed on that 50,000 minus, in this case, the $13,850. So it lowers the amount of income that you have to file on your tax return for that's actually taxable. And those numbers change every year. It usually goes up with inflation. They post an updated amount each and every year. So again, that head of household status, you can see it's kind of in between the single amount and the married filing jointly. Tax brackets and a marginal tax rate. This is probably one of the most confused or misunderstood things that I think is out there for people on what is their tax rate. So I'll go to the bottom part of the slide first. What is a marginal tax rate? What that means is you're taxed at your last dollar of taxable income, not every dollar. So if we look at the tax rates up above, let's just use a single person because those are the dollar amounts that aren't in brackets. If I made $40,000 last year, I'm going to pay 10% taxes on the dollars from 0 to 11,000. And then for the dollars between 11,000 and 40,000, I'm going to pay 12%. So you're not paying 12% on that full 40,000. You're paying on these different increments. So sometimes you'll hear people say, I'm in the 22% tax bracket. That's true that your highest amount of income falls in that bracket, but the dollars that are less than that get taxed at that lower amount. So keep in mind when you're working with a tax person or if you're looking at your taxes that you're not paying that full percentage on the full dollar amount. Does that make sense? Does anyone have questions on that part? Seems like that's usually confused or misunderstood by people. So I want to make sure we talked about that. Just like the standard deductions, these dollar amounts change every single year. They go up with inflation. So these are the current 2023 tax brackets. Another area that gets confused quite a bit is a tax deduction versus a tax credit. You'll hear people say things like a tax write-off, which is usually a tax deduction. So tax deductions reduce your taxable income. They reduce your income and how much is going to be taxed. So if you're self-employed or if you're a farmer, think of your expenses. Those are tax deductions. They lower the amount of income that you're going to have taxed. Your retirement contributions. So if you participate in hospitals, retirement contributions, everyone's in IPERS, your IPERS contributions lower your taxable income. So those are tax deductions. Compared to a tax credit, which is an actual dollar for dollar reduction on the taxes that you owe. So the deductions lower your income, which is then taxed by that tax percentage. A tax credit takes off after all of your income is factored, it takes off a dollar for dollar amount that you owe. So like daycare credits, child tax credits, if you have education credits for attending college, those will actually lower your amount that you owe for a $1 ratio. Questions on that? All right, couple slides on some big changes to keep in mind for 2023. Does anyone in here have Venmo or PayPal or anything like that? So there was actually a rule out there that they've delayed for this year, but I think it's important to keep in mind and kind of pay attention to for next year, that for those different electronic payment services, they were actually the IRS was actually wanting people to get a 1099 tax form at the end of the year. So similar like your W-2, it would show how much money you receive from using something like Venmo, which most of the time people are using Venmo to pay somebody back or, transfer money for things like that. It's not actually you're selling something, which is why I think it got delayed. But if it were to be approved and if it goes into effect for next year, keep in mind that you want to make sure you keep some records on those kind of things, because if the IRS gets a 1099 form that says you received $1,000 worth of Venmo payments, they're going to think that you're selling something and that you should have to pay taxes on that. So there's been a lot of pushback on this one because how many people use these services to pay other people, and it's not usually business related, it's usually personal related. So I think that's a big one to kind of keep your eye on for next year, especially if you use those, which most people do. And I think it'll be interesting to see what they implement with this rule. The other thing that I've read on this is that they're talking about raising that amount from $600 to like $20,000. So most people probably aren't PayPaling or Venmoing $20,000.
How would you actually do a record of that? I mean, if it's like, hey, I stopped to pick up a coffee.
So like on,
Okay, here's the $5.
yeah, on Venmo, do you have an option to like put a message in there? Put something in there like personal, pay back for a coffee or whatever. Just so if you get a form, you would not count that on your taxes. And then if you were ever to get audited, you could say, this is what this money transfers were for. It wasn't me, doing a service or selling something. So I would just kind of keep that in mind. If you can kind of throw that in your payments, tag it as personal for some, and then put a short little note.
Say personal, like I just think like I like coffee.
No, I don't think so. I think something with this will probably change next year because I think they'll get so much pushback on it. But I want to make sure people knew it was out there as a thing, just because it could be a big deal if it actually does get passed through. So I don't think it'll actually pass at $600, but again, I don't know for sure. So $600 is the smallest amount that has to be reported for a 1099, which is why I think they set it at that, but it'll be interesting to see what they do with it. So keep that one in mind. In the room, how many people file their own taxes versus hire somebody? So if you file your own, just real quick, if you hire somebody, good portion. So for those that file their own, this is something new. It doesn't actually impact Iowa residents yet, but I wanted to let you guys know about it. That the IRS is trying out a new tax filing service for people that do file their own to direct file with the federal, at least for your federal tax return. So there's like 8 or 9 states that are piloting this. Iowa is not one, but keep it in mind for the future if you do file your own, that it might be a service that's available that wouldn't cost like buying a TurboTax or one of those off-the-shelf things that you might use to do your own. For homeowners in the room, there's a new credit that's available for energy efficiency improvements. And it's actually pretty vague or pretty open on what's available. So if you put in new doors, new windows, extra insulation, things of that sort, and they meet the energy efficient criteria, which I'll put up here the link on where to find that. Then I guess I didn't have a link. Sorry, you can Google it and find it. But it doesn't have to be major spends, major changes to qualify. A lot of your stuff that you buy at the store now for new windows, they're going to be considered energy efficient compared to the old standards. So keep those kind of home improvement, home remodel projects in mind. If your furnace or air conditioner goes out, most of the new units now are considered high efficiency. And this credit is available from 2023 through 2032. And you get roughly 30% back of whatever you spent. So if you put in a new furnace for $5,000, you could get roughly 30% back, up to a maximum of $1,200 per year.
I have a question. Is like this contractor like tell you that? Like, will they like separate out? I don't know. That's a complicated question, but like if you just have a contractor bill for like 1 million things, including like doors, windows, you know, drywall, all of this stuff. Can you ask them for like an itemized, like how does that go down?
Oh, like if you have somebody and they're doing a whole bunch of stuff.
Check like down like door price, window price is like called out.
Yeah, I would probably ask them if they could give you some detail on those specific items for price. Just let them know it's for your taxes. And there is a link if you Google energy efficient home improvement credit. There's a direct link on the IRS website that talks about what qualifies and what doesn't. So we could check that out. But yeah, I would ask them for some detail because otherwise, if it's really vague, it would be hard to justify if they would ever come back and look at you.
Well, they may have a statement from whoever they bought the supplies from. That might be a way to track it too.
Yep.
If they bought from another company.
Yeah, and most of the time, if you're doing a remodel on like an older home, almost everything you're doing for windows and doors is going to be energy efficient compared to what it used to be.
People haven't given any.
Yeah,
Or it's like, yeah, this kind of stuff.
yep. Yep. Any other questions? Yeah. Yeah, usually the windows and the doors, they do have like a white or a yellow sticker that's on there that says this is X percentage energy efficient. So. Yeah. All right, I don't want to encourage anybody in here that's close to retirement to retire, but I do want to share that starting in 2023, your retirement income is no longer counted as taxable income in the state of Iowa. So a big thing for people planning to retire or those that maybe have recently retired. So things like your IPERs, any retirement distributions from like an IRA, any distributions from like the hospital 457 plan, if you've contributed to that, as you're taking money out starting in 2023 and for the future years, those dollars will no longer be taxed in Iowa. So if you're retired, most of your income that would be taxed at that point would be if you have, maybe your spouse is still working. It's only for your income. So if you're married and you're retired and your spouse isn't, yours would be excluded, your spouse's would still count. But that's a specific change to Iowa for 2023 and going into the future. For those that have kids, grandkids, nieces, nephews, I'm not sure how many people are familiar with the 529 college savings plan. We see this, or when I worked at the CPA firm, we would see this a lot with grandparents that would contribute to a college savings plan, and you can contribute up to $3,785 per year per grandkid, per niece, per nephew, per child. And that money is a deduction on your Iowa taxes. And then it goes into a college savings plan that the money's invested and it's tax-free as it grows and earns over time. And then it's used for their college education. And you can transfer that. So say you contribute to one grandkid's college savings plan, and by the time they get to age to go to college, they decide they don't want to go to college, you can transfer it to another child. So just something to keep in mind if you have family members that you'd like to help contribute to their college savings, this is an option. You lost money on the report. Yeah, so this is one where I think depends on what you invest in, but a lot of times it invests like in the market. So if the market goes up or goes down, it could go down. You know, the last year or two, the market's kind of had some downward trends. That one's not as advantageous, but if you're doing it for your kids or they have a longer time frame until they're ready to start taking you out, more than likely the market's going to go back up. So the dollars do get invested, so there may be a little bit of risk, but they generally try to invest in things that are pretty low risk just because of the intent to have it for college. Here's one for Iowa that I think probably gets missed the most out of any that I'd seen when I worked at the CPA firm. And this is for parents that have kids from K through 12. There's a link here at the bottom that you can check out. So you get 25% back of eligible school costs up to $500 per kid. So if you spend $2,000, the max you can get back is $500. And what's really crazy is this covers a lot of different stuff that people don't think about. So I've listed here clothing for school plays, rental of prom dresses or tuxes, athletic cleats. So think of like football cleats, all those different sporting events. If there's something that's required for it that you're spending money on for your kids K through 12, you can get up to a $500 credit back on your Iowa taxes. And I don't know if it's just not well known about or why it gets missed a lot, but most people that have kids, you have most likely have something that would fall into one of these categories that you could take advantage of. So check out that link at the bottom. It's very detailed on, it has a graph that shows here's what's included and eligible, and here's what's not eligible, and can save you a little bit of money on your Iowa taxes. Just have a couple slides left, and these are for options to reduce or save taxes that we have available here at the hospital. So the hospital's 457 retirement plan. This is kind of like you would hear a 401k, just because we're a county hospital, ours is called a 457. But this is a retirement plan that you can put your money into. It can be automatically deducted from your paycheck and contributed to a retirement plan on your behalf. So it lowers your taxable income, and then anything that is any dollars that are invested grow without having to pay taxes until the time that you take it out at retirement. And then the flexible spending plan that's available through WEX, which used to be called Discovery Benefits. So that is our medical savings plan or our dependent care savings plan. So we have quite a few employees that take advantage of this. This was a slide that was posted in our health insurance annual open enrollment renewal, and it just kind of walks through a scenario of lowering your taxable income and how it can increase your take-home pay by reducing how much you pay in taxes by saving for those medical costs and those dependent care costs. With that, I would open it up if anyone has any questions.
I have a question.
Yeah.
Do you have anything on what you have to? Like, is there a certain dollar amount that you have to count as taxes?
I don't, and that's because it changes depending on what your relationship to the person is that passed away. So for kids, it's different. For nieces and nephews, it's different. There's quite a few different rules and how that is impacted, at least from the state level. Usually from a federal level, there's not a lot of tax impact. Most of it's usually state taxes, but I don't have anything specific on that. Yep. Yeah.
This is really random. My boyfriend and I bought a house this year. We do not file taxes together. Do we have to file taxes together now?
Nope.
As we bought a house together.
Nope, you would not have to. You would want that it's in both of your names.
Yeah.
You would probably want to work together, or like maybe one of you take the house costs off on yours or split them. You're allowed to split them. So like your property taxes and your mortgage interest, you would be allowed to just take a statement at the end of the year and then split it between both of yours. So yep, you could.
Is it kind of more beneficial to have the person with the higher income to claim it, or the person with the lower?
Generally, it's probably the one that's higher because they're going to be going into those higher tax brackets. So the more you can lower their income is usually better. Yep.
And does it work the same way as like how at the end of 2023, you know, whatever the status was, because it could be closed like December 15th.
Yeah.
So the amount of like taxes that we paid for it or whatever.
Yeah, so you probably won't really have much for deductions related to it this year since you closed so close to the end of the year. But yeah, what's that? You wouldn't have much this year because you probably didn't pay property taxes since you bought it so closely in the year. And if you bought it in December, you maybe didn't even make your first mortgage payment until January, so there'd be no interest on your loan. So yeah, you probably won't really, you might get a statement, but I doubt it'll have much impact, if any, on your taxes for this year. Yeah.
And then the first time buyers, is that the same thing or is that different? I don't know.
First time home buyers is completely different. I don't know a whole lot about that. I know when I worked at the CPA firm, there were a lot of people that had that. But I haven't had any involvement with that for quite a few years now, so I'm not sure how that all still works. Yeah.
What about if you're close to retirement, which I'm not thinking about it. They say you should have like 3 of your highest gain years before you retire. So to take out and benefit of the investment, to bring your
That, like,
the 457.
Yep.
The money, whatever that is.
yep.
That will bring your taxable down and what you earn. So is it beneficial to do that when you're close to retirement? Because you want probably your highest. Social Security, or does that?
So like this here, the 457 plan wouldn't impact your Social Security at all. It lowers the amount you pay for federal taxes, but it doesn't change anything on your Social Security filings. So from that standpoint, it would be good. I think so, because if you put money into it, you're gonna lower what you're paying in taxes now. And then when you retire, you're not gonna pay money on that in the state of Iowa, since they took that out as something that's no longer taxable. So it's gonna lower your income now. And you're only gonna have to pay federal taxes on it when you retire, not federal and state. So I think it would be a good thing from that standpoint.
I have 2 questions. Why would it be better to put money into this 5, 4, 5, and 7 retirement plan versus just putting more in your IFRS?
So IPERS is already predetermined. The rates are already established, so you can't raise or lower it. Whatever the state sets for IPERS rates, that's what the hospital has to follow. That's what every employee has to follow. So this would be something that you could contribute to in addition to your IPERS. So when you go to retire, you would have both your IPERS plus this option. So it gives you another. No, it's basically the same thing as an IRA. It's something that usually keeps people more on track because it comes automatically out of your paycheck. So you don't have to take the step of getting paid and then transferring it to an IRA. And it's all reported on your W-2 at the end of the year. So all of that is already baked into your one tax form. But either one is fine and gets you to the same.
And then a question more about these things.
Yeah.
Did you apply for the homestead tax credit? I'm not really sure what it is, because I haven't done it. You did, okay,
Through the courthouse.
yeah.
Yeah, that's something that'll lower your property taxes. The homestead tax credit will. So it'll lower the amount you pay for property taxes through the county when you get your property tax statements. Yep. Taxes. They're everywhere.
I could just like talking and asking and I'm listening because I'm with you.
Which completely goes back to that first question, who wants to lower their taxes? Whether it's payroll taxes or income taxes or whatever the tax is, everyone wants to lower their taxes. They're everywhere. Any other questions?
More knowledgeable, maybe. You know.
Have a better idea.
Yeah.
Yeah, if you have something that pops up afterwards, feel free to shoot me a message, give me a call, stop by my office. I still do a handful of taxes for family and friends and things like that on the side, so I'm definitely not an expert, maybe like I used to be when you're doing it all day, every day, but I enjoy reading about it and learning these kind of things. So I know that sounds dorky, but everyone has their thing they like, right? I do everything. I buy one of the off the shelf products that you can use and I e-file everything. You get your refunds a lot faster. I like it because there's usually something in the top to check for errors. So if you don't know 100% what you're doing, it's a good way for the system to check you. So I've used TurboTax in the past. There's a lot of them out there that you can use, but I usually would recommend buying one if you're going to do it yourself.
When Probably one of those dumb questions. So like that one tax deduction that you said, for textbooks and
Yep,
prom dresses and whatever. I mean, you have to have receipts for all those.
you do. Yeah. Yeah,
That's why people don't do it. They don't. do it.
yeah. And that's why I think it's important to know about, because if you know about it, then you
Yeah.
I
can,
might start it. now.
yeah, throw
Yeah, if they go on and eat on that.
throw it in a file and keep it when you get to the end of the year. This is what it looks like if you go to the state's website, and like I said, the link's at the bottom there, but it just has a graph that shows here's what counts, here's what doesn't count. So it's really easy to follow and pick out what does and doesn't count. So yeah, if you know about it now and you want to start a file or start somewhere, you just throw your receipts in a box or whatever, then when you get to the end of the year, you'll have it all gathered. I don't know. So, I mean, do you pay any tuition or anything for that? Is there a cost associated? I would think yes.
Like $100.
Yeah, it says any tuition for any K through 12 school that is accredited. So I would think yes. I mean, even talks about like at the beginning of the year, you get your list of school supplies you have to buy. So pocket folders, spiral notebooks, pens, pencils, backpacks, rulers, any of those items that are required as a school supply list count. So if you do your back to school shopping and you buy all those items, those all count. Which everyone has to do that, so. You would get,
The max and the times 5%.
yeah, the max was $2,000. So the most you can get back is $500 on your taxes. So you have to spend up to 2,000 to get 500 back, but if you spent 1,000, you would get 250 back. Yeah, it's especially if you have to buy it anyways, right? It's like, why not get it back?
Because school tuition, have to enroll your kids in school. I know some places are free, but ours is $50. Actually, no, I think it went up to 75 for tuition.
Yep, that would count. Yep, that would count.
What about school lunch?
I think it says in here lunches do not count. Yeah. Food, lodging. Yeah. If that were the case, I would never let my kids take food from home.
Retirement income is taxable, but probably earnings on like an IRA or something you took out an IRA, the earnings would probably be taxable.
Nope, any amount that you take out for the state of Iowa, any amount that you do as a distribution or withdrawal would be exempt from taxes for Iowa.
Date.
State taxes, yep, right, yep, yep. Yep. Which is why I think it'd be really good for like the 457. If you're close to retirement, you could put that money in now, save on it, and then only have to pay federal when you retire. So. Yeah. All right. Thank you, guys. Thank you for all those on Zoom.
Favorite.